Hello everyone. Today is Wednesday, April 3rd, 1:28 p.m. Eastern Standard Time. The market is open. I'm Nick Fenton, founder of TickerTank.com, and what I'm going to do today is the start of a 7-part series that I've mapped out for naked put entry criteria. I did uh, I hosted the Wednesday chat at Thinkorswim recently and discussed this topic. It was very, very well received, and so I thought I'd put it together here on YouTube to share for free with everyone out in the YouTube land that would like to learn about this specific strategy. So again, it's going to be 7 parts. Part 1, right now, we're going to discuss liquidity and diversification. So I talk about liquidity a lot. I've done a video already on liquidity parameters. If you've seen that, you probably already know what I'm getting ready to say. The number one thing with any option strategy, period, it has to be a liquid options market. So how do you know if it's a liquid options market? We'll pull up SPY just for an example. SPY is very liquid. Let's look at the May 13th regulars. So first thing you can see here, there's several different options offerings here in SPY. You've got your April 1 weeklies that expire in 2 days. That's what this little 2 here in parentheses means. So it's the weeklies. And 100 shares per contract. That's what that 100 means. Then you've got your April mini weeklies. So this is 10 shares per contract. The minis are a fairly new product. They're not quite liquid just yet. I've been keeping a really close eye on them. So again, those expire in 2 days. 10 contracts per share. Then you've got your April 2 weeklies that expire in 9 days. And you've got your regular April options, your regular April minis, etc. So you've got a few different weekly offerings, you've got a few different mini offerings, and you've got your standard expiration options that are here in this April 13th. 16 days left, as you can see. I have a position on in that particular expiration month. But let's look at the May 13th that expire in 44 days, just the standard options, the 100 shares per contract, not the mini. So we're going to expand that. And what we want to do to determine if this is liquid is look at the closest to the money strike. Right now we've got SPY at 155.50 basically. So you can look at 155 strike or the 156 strike. We'll just look at the 156 strike since we're trading a little over 155.50. We're at 155.55 to be exact. The 156 strike in May, we've got 280 on the put side for the bid. So we're looking at the bid column here, 156 strike, 280. The ask is 281. The difference between 280 and 281 is 1 cent. So you've got a 1 cent bid ask spread. That's optimal. That's exactly what you want. This best case scenario, 1 cent bid ask spread. Minimizes your slippage potential. It's the best possible bid ask spread. And that's what you want to look for. That's your optimal situation. The next thing you want to look at is volume and open interest. So we've got volume up here. Let me just change this layout so where it's just strictly volume and open interest to ease things up here. So we're back at the 156 strike. Our volume is 16,000. Our open interest is 62,000, almost 63,000. My minimum acceptable volume parameter is 500. My minimum acceptable open interest parameter is 1,000 on that closest to the money strike, whatever month I'm looking at. So in this case, you can see the volume is well over 500 and the open interest is well over 1,000. So we have an extremely liquid options market here in SPY. This is definitely tradable. Let's look at something else that you may consider trading from an options perspective. And I know a lot of people I've spoke with on the phone that are beginners in options trading have traded this particular instrument, and I would never trade this. ISRG, Intuitive Surgical. So we'll look at the same month. It's trading, just so happens to be trading right at 500 on the nose right now, so that makes it easy to figure out which strike we want to look at. We're sticking with May. We'll look at the 500 strike. The bid on the put side, 25. The ask, 26.70. That's a difference of $1.70. We had a bid-ask spread on SPY of 1 cent. Now in ISRG, we have a bid-ask spread of $1.70. That is extremely wide. That stands for you to have extreme amounts of slippage on entry and exit. So your round trip slippage is very extreme. Long term, that will hurt you very badly. So you want to avoid these types of situations. Over here in the volume column, 14. I said my minimum acceptable is 500. We're almost 500 away from 500. Open interest, 1. We're almost 1,000 away from my 1,000. We're 999 away from my 1,000 minimum acceptable open interest. So as you can see here, this clearly is not a tradable option in ISRG. I would never trade ISRG options, and this is why. Some that kind of teeter on the edge of tradable are names like Apple and Google. So if we look at the May again and we say, okay, we're at 430, so we look at the 430 strike, 2205 and 22, so 2210 and 2230 is what it's currently. So 20-cent bid-ask spread. That's not as tight as 1 cent, way tighter than $1.70 like we saw in ISRG. The volume is just short of 500. The open interest is well above 1,000. So this kind of teeters on the edge. I don't trade Apple options a whole lot, but every once in a while I do. You know, if I really see a great setup, I'll trade Apple options. But for the most part, I do tend to stay away from Apple options. Goog is another example of something I will trade, but I do tend to stay away from. Currently it's at 803, so we'll look at the 805. You can see we've got 2770 and 2790. It's going between 2790 and 28 on the ask side. So you can see we're going between 30 and 40 cent bid-ask spread, getting a little bit wider there even than Apple. Reason being it's a very high-priced stock, so you got to expect a little bit of a wider bid-ask spread. But when you look at the volume here, the volume's 33, the open interest is 446, so it's not quite meeting my volume and open interest minimum acceptable parameters. So I probably would just flat out avoid Goog in this scenario. There are times when the volume and the open interest do meet and well exceed that 500 and 1,000 level that I mentioned. Another name, just one last name since it's so popular, Amazon. May 14, 258 is the current price, so we'll look at the 260s. You can see we got 1255, 1275, 20 cent bid-ask spread, same bid-ask spread as we saw in Apple. 127 is the volume, so it's well short of 500. And we've got 2100 for the open interest. It's well above the 1,000 minimum acceptable open interest. So again, another one of those questionable ones I don't trade a whole lot of. Amazon, Apple, Google, very popular names to discuss trading options, but not necessarily the most optimal names to trade as a retail trader. If you want to really avoid slippage, you want easy exits out of your positions, especially if you're doing multi-leg spreads. You want to stick with stuff that's really tight on the bid-ask spread and has a lot of volume and a lot of open interest. It's going to save you a lot of heartache and a lot of money in the long term. Trust me on that. Now, the second part, so part 1 to part 1 of this series was liquidity. The second thing that I look for when entering naked puts, or considering a naked put entry, is I prefer diversification, but I don't have to have it. So what I'm saying here is I prefer ETFs like SPY, like DIA, like IWM, like QQQ, GLD, SLV, just to name a few. VXX is the VIX ETN. Things like that I really prefer, especially stuff like SPY that's extremely liquid. All these ETFs that I just mentioned have very liquid options, by the way. They're very liquid, and you get the diversity principles. So you don't, when you're selling naked puts, you don't necessarily want that risk of a massive move. Of course, SPY can have a big move if there's a really nasty day in the market and there's some global crazy news that comes out. The market can crash, but your probability of a massive move is diminished when you're in an underlying that already has diversification principles built into it. Whereas if I traded something like I've recently traded, and I actually traded successfully, thankfully, CLF, which is a company, you're taking on managerial risk, you're taking on headline risk, you're taking on several risks when you're selling naked puts in an individual stock. That's not to say that it's a bad thing to do. I'm just saying I personally prefer to sell naked puts in underlyings that have diversification built in. Now, how can you find some good ETFs? Well, I already mentioned a few. You can go over here to this Market Watch tab, and here on the TOS Index Watch, you might have to pop it down. You can go to Public, and there's an All ETFs list. You've got commission-free ETFs, double long ETFs, double short ETFs, ETFs and closed-end funds, and then all the way down here at the bottom, you've got triple leveraged ETFs. So if you really want to do a little homework, you can click on this All ETFs. You've got, let's see here, 644 different tickers that you can roll through on the trade screen and see if they meet those liquidity parameters that I just mentioned. And you can make a list of all the ones that meet those liquidity parameters and keep that list, and then apply those to the future entry criteria that I'm getting ready to go through in the future videos here. So, you know, in closing, liquidity, liquidity, liquidity. It's the most important thing with any option spread, and so it has to be the most important thing with the naked puts option strategy. Diversification built into the underlying is preferred, but it's not mandatory. Like I said, I did recently trade CLF, so I sold some puts in CLF, covered them for a profit. Recently sold some puts in BBRY, which is BlackBerry, covered them for a profit. Recently sold some puts in JCP, which is JCPenney's, and covered them for a profit. So, you know, I've done it, and I have a lot of success selling naked puts in individual stocks. But I've been forced to do it in individual stocks lately because the volatility environment has been so low. You can come over here and take a look at the VIX, and you can see we're down here at 1389 currently in the VIX. So the volatility environment's very low. It's going to be tough to get some attractive implied volatility premiums in these pre-diversified underlyings like SPY and DIA. So, you know, kind of forced to use individual stocks and selling naked puts now, but if and when we do get a pop back above, say, 20 in the VIX, you'll start to see some more opportunities in these pre-diversified underlyings. So that's when I'll start focusing more energy on looking into those for naked put strategies. That concludes part 1. We'll see you in part 2.